Good afternoon and welcome to the first of our Satrix quarterly macro insight sessions. I'm very excited to welcome with us on the stage two true experts on everything macro. On my left, we have Arthur Kamp. He is the Chief Economist of Sanlam Investments, and we have Laura Cooper. She is from BlackRock, a Senior Macroeconomic Advisor at BlackRock. Thank you to you both and welcome. The first question I'm going to ask you before we get to serious matters, and there are plenty of serious matters that we're going to be discussing today, but I have to say at the onset, you both wear very weighty titles on your shoulders, being macroeconomic advisors during such an unstable, uncertain time. Have you taken up any hobbies, or are you considering full-time gardening perhaps? Or how are you finding being an economist during this uncertain time? Arthur?
Nico, good afternoon everyone. Nico, I would say that I walk up a mountain once a week because you've got to look after the old ticker. I am getting on in years. But at the end of the day, I think the only thing that really gets you through is just to remember that a lot of what we've seen, we've experienced before. A lot of what we're seeing at the moment is new. But at the end of the day, you've got long-term guiding principles that you just have to stick to. You can't predict the future. And only thing you can do is try and best understand the environment that you have at the moment, understand the imbalances, and try and figure out how they're going to resolve themselves. So don't get too clever and walk up a mountain once a week.
And yourself, Laura, are you finding yourself reconsidering your career path, or are you enjoying all the uncertainty and getting it right and getting it wrong almost with equal frequency? I mean, are you enjoying the challenge?
Well, I think certainly these market conditions are challenging to navigate, but that also is what makes this role quite exciting and you have to be quite nimble in terms of watching markets, understanding what are the underlying assumptions in these current conditions, how are those changing with data, what are central banks saying. So I actually find it quite exhilarating to follow these markets as well. I don't necessarily have money behind my views, which always helps, but as well as a nice glass of wine at the end of the day is a nice little touching point as well to cap it all off.
That helps. That certainly helps. So, Arthur, let's start with you on the local side, and I'm gonna throw the first few questions your way to get the local discussion going before I turn to you discussing more sort of global macro themes, Laura. I need not remind anyone of the great challenges we face today. Power outages. Corruption is anemic in South Africa. There's a lack of prosecution that's causing a lot of frustrations, a lot of pain in South Africa, economic and otherwise. Now, the BR recently, in fact, this week came out with a business confidence index, and it again showed, that businesses are less confident about the growth prospects in South Africa, and that there's a general feeling of dismay, and a bleak GDP outlook for us in South Africa. Arthur, so I want to ask you, broadly speaking, if you're looking at the patient that is South Africa, what is your pulse? What's your reading of the pulse currently?
Nico, the bottom line is what we need to do is raise our potential growth rate, because without raising the potential growth rate, you're not going to attract capital, and this still remains one of our biggest problems. Our capital inflows on a net basis peaked around 2015 at a significantly higher level as percentage of GDP, above sort of 5-6%. And yes, we had COVID, so that's distorted the numbers, but there's palpably weak level of capital inflows at the moment. Don't have enough domestic savings. So, at the end of the day, the question then is, how do you lift the potential growth rate so you can attract capital if you don't have enough domestic savings? That capital can assist you to invest and grow the economy and employ people. I think the thing that has been brought home over the last couple of years is just that you can't even start without infrastructure. And so it's not just electricity, it's transport as well. And I think that the current direction of government policy is in the right direction, is that they've almost had to go back to the beginning. So before you get to things like skills development and going up the value chain and all this sort of, you've actually just got to fix infrastructure, because without that, you're not going to grow at all. And that's been brought home. It's not just electricity, it's in transport as well. So we've struggled to, this should be a boom time for South African mining. Yes, commodity prices have come down over the last while, but they're still quite elevated relative to history. And the level of investment in mining globally has been quite low relative to GDP. So it's an ideal opportunity to up production, but we don't, because the production we're making at the moment, just to get that to a port, is a challenge in itself. And so we're leaving a lot of money on the table, and with that a lot of potential growth, and with that a lot of potential jobs. So yeah, we got to first fix infrastructure, and then we've got to get on to the other things to raise the potential growth rate and the prospective returns in South Africa, because that's what attracts capital.
So then, of course, Arthur, there's the not so black and white issue of our grey listing and exactly what that means for South Africa. Now, with some time having passed since that's been announced and we've got onto that dreaded list, what's your reading of the situation? And also, what's your take on the finance minister's suggestion that, we got 90% for the test and not 100%, so it's not all doom and gloom and we should get off that list pretty soon? Do you see it the same way, and do you think there's medium to long-term consequences of actually getting onto that list? What does it say about our country?
Well, Nico, I think, we went from 67 points that we had to address to 8 points, so there was a significant amount of improvement. Where we did a lot of the improving was on the technical aspects, and particularly the laws that we've passed earlier this year are very, very helpful. We still have to show effective implementation, and that's not as easy as it sounds, because that involves, not just monitoring, but actually then prosecuting successfully. The FATF does a risk assessment of South Africa, and then based on that risk assessment, we should have a certain level of convictions. And we're quite low given our risk assessment, and we do need to improve that, and arguably that is significantly harder to do. But we have to also give credit, because we have improved a long way, and we are quite clearly showing a willingness to work with the FATF. So I think these are positives. But we shouldn't underestimate that what we need to show is the effectiveness of implementation, and that can be difficult. The impact on the economy is difficult to assess, because you've got all of these other factors that are at play, and we've all seen the literature on this. So, in theory, what happens is that you get less capital inflows. That then potentially, would weigh on the currency. Small open economy like South Africa, inflation pressure, Reserve Bank responds, raises interest rates, growth slows. That's kind of like theoretically what you would work with. But we looked at case studies of countries that have previously been grey listed and got off the grey list. And that doesn't always work out that way. One thing that does seem to be quite common is that the currency does weaken a bit, and especially also in the run-up. So markets tend to anticipate. And I think that's probably been the case here, although try and split that out from electricity and declining terms of trade, not that easy. We've been, I think the other important point to make is we've been put on increased monitoring. So that's different from enhanced monitoring or, enhanced due diligence, which is significantly more serious, if I can use the word. Saying increased monitoring doesn't make light of it. But because our financial sector is quite well ahead of the game here, I don't expect huge impact there. Although it is possible that some countries and some financial institutions in some countries may, of their own, require more greater due diligence, which could cause some frictions. Of course, it does speak to reputational damage to the country. It's not something you don't want to be on the grey list. It does increase compliance costs to a degree, and it has some impact on the economy, but I don't think hugely so. The impact would be far bigger if we don't address the issues that we need to, and as I say, that's effective implementation of the laws, and that boils down to obviously convictions, as I've said, because then you do move on to more enhanced due diligence, and it becomes much more disruptive, and you don't want to eventually get to the point where banking relationships are impaired. A small open economy with a large financial system like ours, that would be really problematic. But at this stage, let's just say, I think it is encouraging that at least we are working with the FATF and are showing determination to address the issue.
So there is some hope, I suppose.
There's always hope, yes.
I think you also recently wrote a very insightful and concise summary of the budget that came out. And I wonder if you can expand a bit on your view. I know you said that the minister did as well as can be done currently. So, giving them good marks for effort there. Where do you see the obvious challenges, though, going forward in terms of budget, in terms of budget allocation, where we put our emphasis in terms of getting the economy back on its feet?
Okay, so unfortunately, I mean, I did write, and I stand by that it was as good as could be done under the circumstances. The problem is that the circumstances point to a lot of expenditure pressure and, unfortunately, a lot of pressure potentially on revenue as well. So, I mean, I'm quite wary when I see declining terms of trade. Commodity prices are still reasonably elevated, but they've come down. And we've seen quite a sharp fall in the terms of trade as measured by the South African Reserve Bank over the last few quarters. So when you see that, your tax buoyancy tends to weaken quite significantly. And there's always then a question behind revenue. And then, of course, just generally where the economy is, it's not beyond the realm of possibility that growth just completely stalls this year. And so you may find challenges already on the revenue front. And then also on the expenditure front, there have been reserves set aside within the budget. But I don't think that they cover potentially all the spending pressures that are coming our way. So one of those would be obviously wages, the wage agreement, and we've seen that, the kind of like increases in current prices that are being projected in the next 3 years, very difficult to live off in such a high inflation environment. So in real terms, government employees' wages are going to be under significant pressure, and I don't think, so that's always a risk of demanding higher wages and getting higher wages. And then also the social relief of distress grant is, in my opinion, likely to have to continue through the medium-term expenditure framework, which is not budgeted for in the outer years, and adjusted for inflation, because the kind of socioeconomic pressures that you have in South Africa aren't going to go away overnight, and you can't ignore them. So I think the spending pressures are going to be significant, and I think there's risk on the revenue side as well. So that's the first port of call. That's but the other issue is the broader balance sheet of the state. So we can talk about central government finance, but the one thing that came across in this budget was that contingent liabilities sometimes come home to roost, and in this particular case it was Eskom, and I think it's been dealt with relatively effectively. But the point being is that if you look at the last number of years and the amount of transfers that have gone into Eskom, it very clearly speaks to the point that you can't just look at the central government's finances, because you've got these contingent liabilities building here. They've been costing us already, and it's going to cost us going forward, because ultimately Eskom support is going to end up in a higher borrowing requirement than would have been the case, and a higher debt ratio than would have been the case. So we've been talking about stabilizing debt for years, and a peaking debt ratio, and we just never got there. So each budget we're just pushing it out and pushing it out. And here we are again, the medium term, it doesn't stabilize, it's still going up. So for me, the main concern is that when you look at government finance, you can't just look at it from the perspective of budget balances and even debt ratios, but you've got to bear in mind these contingent liabilities which come and just sort of almost destroy your best laid plans.
It's a great point. So it's not only about quantity, it's about quality of debt as well, because a lot of the listeners might be confused when we talk about the high debt levels in South Africa, especially if you compare it to other developed market regions. I mean, Japan is running at 230% debt to GDP, Spain at 170%, the US, France, UK, all well above 100% debt to GDP. So we seem like we are living well within our means from an absolute gross loan perspective. But like you said, I mean, it's about the quality of the debt as well, not just the quantity. So how would you answer just our debt levels briefly? I mean, is it a concern to you, the level of debt?
Yeah, absolutely, it's a concern, because, and from a couple of perspectives. So the one is that we're paying very high real interest rate on that debt. All the newly issued debt is being issued at a very high real interest rate. That in itself wouldn't be a problem if you were really growing fast. But when you're not growing fast and your potential growth rate at the moment is, 0.5%, 1% real, and you've got a very high real interest rate, then that gap means that you have to run a really significant primary budget surplus to stabilize the debt ratio. Problem with that is, as I've just described, it's very difficult to run that primary budget surplus when you've got the socioeconomic stresses that we have, and which will not go away, because the weaker the economy is and stays, the less you employ people, sufficient people, and the more that you get those socioeconomic pressures. So the more the pressure comes back on the budget. So the only way to solve South Africa's problems, all of them, not all of them, most of them, is to grow the economy faster. Otherwise, in the long term, the fiscal math still just won't work out.
That's a great point. I think especially with local bonds offering attractive yields, do you think this is a fair reflection of the risk that you're taking, both sovereign and otherwise? And is this an opportunity currently? I mean, we look at the yields across the yield curve spectrum. I mean, it is incredibly attractive from a local perspective. And Laura, I'm going to get your sense on that in a second from a broader EM perspective. But locally, do you see yields as being attractive, or is it a reflection of the increased risk?
Yeah, so this is where valuation comes in. So we've just said that the budget is a problem, long-term fiscal policy is going to be difficult to stabilize. But that's the point, is that the real yields are high because they are compensating for the risk. So if you look at our conventional bond yields, where they are at the moment, the market's pricing in just over 6% expected inflation over the longer term. So you've got to decide whether that's sufficient compensation for you. One question I often get is, are we going to default in our debt? Now, the risk of default is not null. But in South Africa's case, I think the risk is skewed in the short to medium term, at least, to inflation and the currency, because most of our debt is issued in rands. And if you run fiscal policy that is too loose over time, then the risk is inflation. So you've got to decide whether that just over 6% is sufficient compensation. We've been of the opinion that not quite enough, maybe. We've been concerned that, and so we've been more overweight inflation-linked bonds. But the point being that the higher real yield does reflect the higher risk. So you are being compensated, and in particular, you've got to figure out where you think that inflation compensation is sufficient.
And so, Laura, just briefly to you, before we get stuck into the details of what's going on globally, I mean, just on EM debt, are you overweight, underweight? Do you think, especially considering how developed market yields are increasing, I mean, is there still opportunity in EM debt?
We think there still is opportunity in EM debt. We're cautiously optimistic on the asset class, notably if we start to see less rates volatility than what we saw last year, given central banks were quite hawkish in terms of the pace of tightening in their policy rates. So if we look going forward, we do think the key headwinds to EM debt that we saw last year, notably the prominent dollar strength, the rate increases that we saw from developed markets, are now shifting. We're nearing the end of tightening cycles in developed markets. We do think the dollar has reached its peak. We do expect depreciation to come throughout the rest of the year. So we do think now is an attractive opportunity to get exposure to that asset class, notably on a local currency basis.
Fantastic, thanks. Before I give you a breather, I know I've stressed you, or I've stressed my asset on my left quite a bit now. But before we give you a breather, I think, Arthur, can we perhaps quickly touch on currency weakness, so the rand's recent weakness, and there's, I suppose, lazy analysts would point to the obvious culprits being grey listing, anemic growth, corruption, all of these things that's causing weakness in the rand. But I think a more sober look at this would consider a broader view. I think we've come to know that what drives the rand is not really what happens internally, which is a strange comment if you don't come from South Africa, is that the rand is very much a reflection of what's happening globally and with asset movements there. Now, current rand weakness, what do you attribute that to? And what is your outlook on the rand? I know it's a dreaded question for any macroeconomist to ask what's going to happen to the rand, but what are you seeing structurally causing the weakness of the rand? I mean, is it internal? Is it external? How are you seeing that?
Nico, so if you look at the rand dollar, it's one of those currencies, it's certainly not the case for all currencies, but it is one of those currencies in the very longer term does in fact drift along with inflation in line with inflation differentials. But it does deviate for long periods of time, and sharply so, and could be for years. And those deviations typically come during times when global financial conditions are tightening. So the Fed matters when the Fed is raising interest rates, and the other one, of course, is when commodity prices are moving. So, if you've got high commodity prices, it tends to support the currency. And what we've had over the last, we had that for a while. Post the pandemic, when commodity prices recovered and the rand recovered along with those commodity prices, and then through that half of last year, when commodity prices started to fall, export commodity prices, and the currency came under some pressure. The Fed also then, tightening more than anticipated generally by the market, and so that those two factors, I think, are weighing on driving the currency away from that long-term trend. There is an add-on, and the add-on is is electricity at the end of the day. Because why? Because electricity damages growth prospects. So again, you're not seeing a huge attraction for capital coming into the economy if growth prospects are very poor. And then at the same time, the grey listing probably to a degree, although it's quite difficult to show that empirically. But you're quite right. So you don't lose sight of the fundamental drivers, because that's quite important going forward as to where the currency is going to go. So historically, when you have seen the rand weaken very sharply, sustained period of time, the turning point is normally when the Reserve Bank has tightened sufficiently to compensate and to maintain and to bring down long-term inflation expectations and inflation outlook. That's normally a good anchor for the currency, and then you normally see the currency coming back quite nicely over the next couple of years. It does help if commodity prices are stronger. So there it's a bit more difficult, because what we have had globally is a dearth of fixed investment in mining relative to GDP for many years, and so you've got this lack of supply. So even in a demand environment that's not especially strong, there is a level of support for commodity prices. China, that economy seems to be opening up. The general expectation is going to do a lot better this year. That might be not a longer term thing, but in this current year you might see significantly higher growth, and that could be supportive. You've got to weigh that up against potentially what happens in the US. But there may be some support for commodity prices, in which case so a combination of the SARB tightening and commodity prices holding up or getting maybe some improvement, your base case is that given that the rand is so cheap at this point, that over the next couple of years it could strengthen. Yes, there was always things that could drive it away or keep it undervalued for a longer period of time, and we know what they are. Particularly electricity is probably the most important one. So what you've got to hope on that front is that into next year, if you look at the plans to bring supply online, if you get a significant amount of that, and this because there's a huge amount of megawatts that are planned to come online over the next 18 months, you just have to get maybe half of that to alleviate a lot of the pressures that we're seeing now, and suddenly you're looking better next year off a very weak base this year. So with the currency this week, as I say, you can't predict the future, but based on those observations, we would ordinarily sit here and say, well, you know what, we think this currency should do a lot better on a 1 to 2 year view.
And you mentioned the Reserve Bank. So, a lot of people might argue that we are following the Fed. We are kind of raising rates in lockstep and causing some disconnect between the inflation rate and where our rates are going. Do you see that as plausible? I mean, to what extent do you think the inflation and currency stability should remain the main thing for the Reserve Bank, or should they start considering a wider impact of their monetary policy? What's your views on that?
So I've said the Fed matters, and the Fed does matter, but the Reserve Bank, our Reserve Bank is a very effective inflation targeter. They started hiking quite early, and they hiked quite aggressively when they needed to. And I think it was coming off a very low base, we've got to remember that, but they did move quite early and quite quickly, and so we've got to remember that they've come a fairly long way already. My own personal feeling is that, we're a small open economy, we are price takers in the world, and the currency is extremely volatile as a result of it. And so factors that have a big influence on consumer price inflation in South Africa is because we're still an emerging market. So things like food has a high weighting in the overall basket. We find that, currency movements filter through very quickly into inflation expectations. And it's difficult enough to maintain your inflation target against that backdrop. To add something on like a growth objective, which is sort of being suggested now, would be make it very difficult for the SARB, especially since it is really not monetary policy that's the growth problem, causing the growth problem in South Africa. In fact, I think that it's made a positive contribution by bringing down inflation under an inflation targeting framework to a much lower level than what we used to know many, many years ago historically. And so to now lump on a growth objective where the real problem is infrastructure, lack of skills, those real supply side problems, it just puts the focus in the wrong area and makes it very, as I say, so the fact that we're a small open economy, a lot of volatility in the currency, And the fact that our growth problems are really not rooted in monetary policy, but in supply side issues, I just don't think it's a good idea to give the SARB that additional responsibility of trying to sort of lift growth and reduce inflation at the same time.
Yep, I would agree with that. I think, Laura, if I can come to you and let's discuss a bit, on the global side. Now, you and I both were at the Investment Forum yesterday. It was a fantastic event, and I think that the key thing that came out for me is the sense of fear and uncertainty was almost palpable as advisors are looking for guidance and some form of stability in terms of outlook. It feels these days that the key themes that worry investors changes, almost as quickly as the next dance routine on TikTok. Although I've taken in confidence that Arthur is more traditionalist when it comes to your preference of TikTok dances. But, it does seem like every day brings new challenges. So if I can start you off with a very broad question, what are the key themes that you see causing concern for yourselves at BlackRock and going for the rest of the year? What would you name the key areas of concern for you?
I think the key area of concern really stems from the inflation outlook. We are in this view that we are in this new macro regime where this kind of pronounced period of this great moderation where inflation was low, rates volatility was low. We now think that's come to an end, and we are in the pronounced period where price pressures are going to be with us for quite some time. So it's really about thinking, how do we position portfolios in this environment? So when we look at the day-to-day price action that's come through, we think that's coming off the back of data that's proving to be quite resilient in the US as well as in Europe. Central banks have emphasized that they are going to be data dependent. So markets are left to recalibrate their expectations around policy paths. And there is this risk that we could actually see this further tightening in financial conditions to such an extent that it prompts recessions in both the US and Europe. At the same time, we're still left with elevated price pressures. So it's a really different environment, I think, for investors to navigate. And that's why we are left with this period of uncertainty that a lot of us are still trying to grapple around. What does the future look like?
So you mentioned data dependence, and certainly that drives the Fed, right? But I've seen some question the Fed's stance and maybe even being myopic in terms of their data dependence. And have appealed for the Fed to take a more conservative stance when it comes to their sort of aggressive tightening. I wonder what you think about this, that point, specifically considering the amount of nuance there is in how we get to that inflation number, the nuance there is in jobs numbers in the US. I mean, how much trust do you put in these numbers, and should the Fed be blindly guided by the data as they currently try to portray they are?
Well, if we think about what the Fed's mandate is, it's to really get price pressures back to that 2% target and to keep inflation expectations anchored. So yes, they've maintained this hawkish tone when some are arguing that they don't need to be as aggressive. But ultimately, it does come down to the fact that inflation is still quite elevated, that 6% handle on US CPI. It does really suggest that we need to continue to see their hawkish rhetoric persist. The key question, though, is the underlying strength in the economy there that it's been able to absorb the aggressive pace of tightening so far? Or is it because we have yet to see the lagged impact of that monetary tightening come through, in which case we could actually see quite a sharp downturn as that starts to feed through? So I think the Fed is being quite prudent in their stance right now. We're likely going to see them raise their policy rates to about that 5.75% mark. Pricing is around that, slightly higher. And it's really key is, are we going to continue to see the strength in the US labor market? Will inflation start to decelerate even more? That's not our view at this point. So I think there's a reason why they're data dependent, because they need to be in this environment where there's not a lot of certainty on the economic outlook.
So hard landing, soft landing, or no landing, which is the scenario where the US economy just keeps flying. I mean, on which side of more likely than not do you sit with that?
Well, I think we're data dependent to a certain extent as well, because the more that this US data comes in surprising to the upside does suggest there's scope for policy rates to tighten even more, and that raises the risk of a hard landing. Now, that's not our base case at this point. If anything, we do think we are going to see a US downturn fairly short and shallow, so about a 1% peak to trough, as we start to see some of those increases in rates last year feed into those non-real estate type of sectors. But the more that we see the resilience of the data, I think it's really why we're watching the payrolls print later today quite closely. We're watching the evolution of inflation as well, because that will really dictate what kind of outturn we see in the US economy.
So you mentioned that the Great Moderation is all but over, at least how we saw it in the past. Would you say there's a change in the investment book? I mean, sort of investment playbook, sorry. Is there a change in how we should approach investments? I mean, and related to that point, where is your stance on the neutral rate currently and going forward?
That's a great question. And actually, in our recent outlook, it's titled The New Investment Playbook, to account for the fact that we do see this as a new macro regime. And I think the key change in this new environment is really about, seeking alternative sources of diversification. So typically, we would expect to see bonds as a nice ballast in portfolios, providing that income to offset some of the alpha generation within the equity sleeve. But this time is different in the sense that because we are in an elevated inflationary regime, we don't think that bonds will act as the ballast in portfolios that they have in the past. So we are underweight duration on both a tactical basis, but as well on a strategic basis. So if we think about investors are likely going to demand higher term premium to hold those US government bonds most predominantly, and as well elevated public debt loads, we think there's more caution towards holding fixed income in the sovereign rate space.
You mentioned that the Fed is doing prudent or acting prudently by aggressively tightening and trying to curb inflation. Are they doing enough though? And also, what is the main source of global inflation currently? Where do you see that?
Well, I think is the Fed doing enough? I mean, at this point, the fact that inflation expectations remain well anchored does suggest that they are continuing to achieve their mandate. Yes, we are still seeing headline price pressures elevated, but they have yet to kind of signal that they're going to be more comfortable with a higher inflation type of mandate. So I would say so far they are doing their job. Notably, we have to see the evolution of data, and that's clearly their messaging as well. They're continuing to be data dependent, despite markets potentially suggesting that the Fed could actually ease rates after they reach that terminal rate, which again is not our view either. We do think policy rates are going to be held in restrictive territory for quite some time, which is quite a sharp contrast to traditional business cycles where we would expect that easing to start. In terms of what's driving the global inflationary backdrop, well, I think it's interesting in the sense that we have seen the goods deflation come through quite pronounced, notably in the US. We are seeing those gauges of supply chain pressures return back to levels that were pre-pandemic, which is quite significant. But I think the key challenge, though, is yes, we've gotten from elevated single digits of US CPI back to that 5 to 6% handle. Getting back to the 2% target, we think will be much more challenging. If we look at the key drivers of that goods disinflation, shelter was a key component underpinning it higher, but we've seen used car sales kind of be a key driver of that lower prices. We don't think that's going to be the key tailwind going forward. And if anything, we think goods inflation is probably steadying from here for the next few months. And we're looking at the core services ex-shelter component. That still remains quite sticky. Wage pressures are a key component of that as the labor market continues to be tight. We are watching that metric. So I think getting back from that 5 to 2% will be quite challenging. That's why we're continuing to see the Fed being as hawkish as they have been.
There also seems to be a liquidity mismatch currently, with the Fed leading the charge against inflation. But at the same time, we're seeing a dovish Bank of Japan. We see the CPOB, not raising their rates. I mean, to what extent do you think this is undermining the Fed's efforts to actually curb global inflation? And related to that, how do you see dollar strength panning out for the rest of the year with that being in consideration? Because the carry trade currently looks fantastically attractive for the yen.
Well, it's quite interesting, actually, in the sense of when we talk about the liquidity backdrop, because yes, we have this quantitative tightening come through from the Fed, ECB, Bank of England, but yet it's like you mentioned, the Bank of Japan has actually been a predominant buyer of bonds. We've had the PBOC as well amp up their credit supply. So this does suggest to us that on net, we've actually seen an increase in global liquidity, which we think has provided a bit of a tailwind to overall equity markets. So I think we've yet to see this material tightening in financial conditions that maybe one would expect in this environment of DM central bank tightening. So that's one to watch for, because we don't think that's going to be persistent, as we do think that the Bank of Japan will end their yield curve control probably in the next couple of months. So that's kind of the key factor that we are watching there. In terms of the carry trade and the dollar, it's been, certainly the price action in February was surprising to us in the sense that we did see this repricing of Fed expectations. So it was really those front-end yield differentials that drove that renewed dollar strength. But it's also coming from a very low base. So if we look at the underperformance of the dollar in January after a remarkable 2022, we really saw that it was net short positioning. So there was a bit of a short squeeze in February. Going forward, if we think about what the key drivers have been of that dollar strength around the front-end pricing for a very hawkish Fed, if we think about the kind of the U.S. growth dynamics, we think those are now fading to such an extent that we are seeing this improving outlook in Europe. We do think the Fed is nearing the end of their tightening cycle, whereas other DM central banks are still kind of playing a little bit more of that catch-up. We do think the ECB is probably going to hike well beyond the Fed. So those are the key drivers that we think will underpin dollar depreciation going forward.
So before we get to equities and other asset classes, just on the, on where do you see opportunities in yield? Is it on the short end of the yield? Is it in the belly of the yield? The long end? I know you mentioned your underweight duration, but specifically, where do you see the greatest risk currently on the yield spectrum in developed markets?
So we think short duration credit right now is quite attractive. If we think about, if we look at US, for example, you can actually get quite attractive yields that are just slightly lower than taking full duration exposure. So in this environment where inflation remains elevated, there is still this uncertainty around central bank policy paths because of the resiliency of the data. We do think that it doesn't necessarily pay to take either the credit premium, the credit risk, or the duration risk. So it's taking short duration, high quality credit, as well as taking cash-like exposures really at the front end of the curve is where probably you're being paid to hold cash-like instruments in this environment.
So Laura, if we can turn to equities, a somewhat controversial but always interesting figure, Nassim Taleb, recently suggested that higher nominal rates have caused gravity to come back into the system, specifically in reference to closer scrutiny of company balance sheets and a greater emphasis returning to sustainable cash flow management. Now, do you see this as changing the dynamics in equity markets, and where do you see the opportunities presenting themselves in a world specifically of higher nominal yields?
Well, I think it's been interesting in the sense that despite the backup in yields that we have seen kind of those long duration proxy-like stocks like tech hold up fairly well, largely because of their strong cash balance sheets that companies have really been able to build up those cash buffers against this period of low rates. But I think going forward in this higher inflation, higher rates environment, it's about taking a very selective, granular approach to equity exposures rather than taking on broad benchmarks. So it's looking, first of all, from a very defensive lens. So looking at healthcare, for example, where we are seeing that stability of earnings. We do think there's still this pent-up demand from COVID that is yet to fully play out. And then as well, we have the long-term demographic benefits to that sector in particular, given the fact that we are seeing aging population. So demand should remain quite firm there. And then it's balancing that with taking on slightly more cyclical exposures that are going to be beneficiaries in this higher inflation, higher interest rate environment. So notably, financials has been a conviction trade of us. Yes, we've seen some volatile price action more recently on the back of some concerns of contagion from US lenders. At this point, we do think that is going to be contained. So we still do like this sector, notably because it's underperformed relative to what we would expect given where yields are. And then as well, it's looking at other kind of value-like exposure. So energy is a key area that we do like. As was mentioned, that we have seen really this period of underinvestment. So that we really have supply constraints overlaid with this kind of long-term demand from this transition to net zero, we do think will be quite supportive for the sector. So it's about really being quite granular in terms of equity allocations in this environment.
So on that, I asked you earlier, EM debt, what's your view? EM equities, what's your view there?
So we've actually recently gone overweight emerging market equities relative to developed market equities, and this was largely on the back of the China reopening story. So yes, caution is warranted on China from a longer term perspective. We do still have the potential for US-China fragmentations to escalate once again, but if we look at this as really a tactical type of play, we do think that there's going to be more policy stimulus to come through. Consumer confidence is likely going to kind of increase at the margin. And overlay that with what we expect will be this revenge spending coming in from the domestic consumer in China will have positive benefits to Chinese equities, but as well as positive spillover benefits to some pockets of equities as well, notably in Europe.
That's a great term you mentioned there, revenge spending. I don't know, Arthur, if you've heard of that. Or you go on random revenge spending sprees, but that's certainly an interesting way to think of it. I mean, getting out of lockdown and starting to spend. On that, Laura, what type of China do you think is emerging? Because a lot of people are saying China's going to re-emerge after their self-imposed hibernation come out, and this is going to cause a bump up in inflation. I mean, what type of China is emerging, specifically considering their ongoing efforts to centralize their economy? Can you breed innovation, from a centralized perspective? And what are we going to see emerge from China?
Well, I think our view on Chinese markets in particular reflects the change that we are seeing kind of more broadly in the composition of the Chinese economy. And that's why we have a very tactical overweight view on EM driven by China. But more strategically, we are quite cautious because we think, as you mentioned, that the drivers of Chinese growth are going to be quite different because the motivations behind kind of the policymakers' stance is different as well. So we think there is this pivot more towards common prosperity, social cohesion. We are seeing demographic headwinds come through with the population outright declining. So we think potential growth in China is actually going to be closer to about 3%, whereas historically it has been more around that 5% mark. So it does suggest that investors will need to have higher compensation for taking risk in that market. So that's why we're more cautious kind of on the more strategic basis because of the growth drivers.
So Arthur, you've heard us talk about changing investment playbook, that gravity has returned to the market. Where do you see the current geopolitical, monetary policy and trade uncertainty actually play into the valuation of risky assets?
Wow. That's put it this way. I think that the world has fundamentally changed, and I think the key point here is we've moved from a world where you've had integration of global economies, you've had integration of emerging market economies into the global economy, the demographics that came with that, the production that came with that, driving down lower inflation, global supply chains, driving a process of higher growth and lower inflation for a long time, and now that is changing. So we're moving into an isolated world where we have much more focus on protectionism or home bias in that sense. We also have, geopolitical risk is clearly elevated. So, if you look at the Russian-Ukraine conflict, at the end of the day, the bottom line of that conflict is that you've entered into something similar to a Cold War situation, which is not necessarily going to end overnight, and it's going to linger for quite a long period of time. And we know that what wars do is that they worsen the trade-off between growth and inflation. So you've got these, and also it does seem to be what it's starting to do is also result in regionalization, which is pull back from the kind of world that we knew. In a world like that, as I mentioned, most importantly, worsening growth inflation trade-off, and you're going to have to be a lot more careful in picking your winners in a world like this. And also with, for example, just within Asia, and you look at the Asian region, I agree fully with Laura in that the potential growth rate in China is not what it was before. I always get concerned when I see a very high elevated level of investment to GDP, along with a high level of capital stock to GDP. It's just that much harder to drive productivity. But within that region, what you're starting to see is something happening elsewhere. So you start asking the question, is India your new winner? Now, in some respects, India's got very similar problems to South Africa in terms of income inequality, but it's obviously got a lot more dynamism. It's an open question as to whether it continues growing at 6%, but if it continues growing at 6%, suddenly within a few years from now, it's really one of the three biggest, probably maybe the third biggest economy in the world. So one question is China passing the baton to India? And within that region more broadly, what you're also seeing is with China becoming a more labor expensive environment to do business in, you're starting to see manufacturing shifting elsewhere within the region. But then at the same time, so the world is going, if you look at end of the day, what do investors want? Investors want high growth, low inflation, high productivity. And within this regional kind of like framework, you've got to look at the emerging markets of Asia more generally and also outside of China as being countries that can deliver longer term growth. We know about developed markets. Demographics counts against them. And in other regions like ourselves, parts of Latin America, you've fallen into middle income traps. So for me, long-term prospects for markets are always tied very strongly to growth. And that's why I look at that region. But there's going to be a lot of bumps and bruises because geographical risk is elevated. And we're seeing that. We even have questions within our own country about, support for BRICS relative to the rest of the world, or alternatively, our neutral stance towards Russia, whether that's the appropriate stance. So all of these factors are going to play in. But the bottom line for me always is I look for the markets that are going to consistently deliver the higher growth as a key differentiating factor.
Laura, China passing the baton to India, it's an interesting comment. And what's your view? If you compare India and China, do you see them both as opportunities? How do they differ in your opinion? And what's your view on both?
So we do like India from a medium-term perspective, largely because, yes, we do think they are grabbing the baton from China in the sense of we do think really the demographic tailwinds are now with India as it kind of embraces this growing middle class. And as well, it's a very different type of composition of growth than what we saw in terms of China's resurgence over the past number of decades. We do think it's more going to be in the high-skilled tech, innovative type of sectors, and we are seeing some policies come through at the margin that we think could support that, as well as potential for import barriers to be reduced. So that provides a bit of a long-term story. So that's probably where we are seeing the medium-term focus shifting as China becomes more of the stable growth player in the broader macro backdrop. So
we've discussed many different opportunities, risks, everything facing the global economy. I want us to take a step back and say, if I gave you a magic wand, right? You, for a day, what you say becomes law and comes into practice. So Arthur, let me start with you, and I'm going to give you a similar magic wand in a second, Laura. If you were given the proverbial magic wand, Arthur, what do you think Treasury and the SARB, and specifically in that order, can do to improve the local economic malaise?
So I think on fiscal policy, it's clear that the problem for South Africa is that while you do not have an elevated potential growth rate, you don't get enough foreign capital. So you're working with domestic savings. If government is absorbing a very high share of domestic savings for consumption, that's a problem because consumption spending does not build long-term growth. And so the more that government absorbs of savings, the less that savings is available for the private sector to invest, grow the economy. And so ultimately, fiscal consolidation sounds quite draconian in an environment like South Africa where you have these socioeconomic problems, but you have to do two things. One is lift the potential growth rate, so you've got to do these reforms and the policies that we have in place and the regulations are coming in place, but now we've got to deliver infrastructure and all these other things we talk about. But on the other hand as well, we do need to have fiscal consolidation to create the space for the private sector. If you do those two things, you're creating more space for the private sector to invest. And if you're raising the potential growth rate, obviously, then you've got more chance of attracting foreign capital, and that's to get the thing going. So, but because it's so draconian to do fiscal consolidation in this very difficult socioeconomic environment, you've got to think about it a little bit more more carefully than just the usual, we cut spending and we cut, because, it's true that you don't easily get fiscal consolidation without cutting spending to GDP, and we do need to cut spending to GDP probably. But you can limit the extent of that cut in spending if you elevate your capital expenditure. Because if you elevate your capital expenditure, you raise your potential growth rate and you raise your potential long-term revenue collection as well. So for me, it's, yes, you've got to cut spending to GDP, but you don't have to be too draconian about it if you, at the same time, up your capital expenditure. Because although your total spending to GDP might not be coming down as much as you would have originally liked, your balance sheet is still quite healthy because you're building the asset side of the government's balance sheet. At the same time, you obviously, as far as tax policy goes, we can talk forever about tax policy, but you need to simplify your tax system, and you need to focus the tax system focus it more on indirect taxes and less on taxing income. And the reason that I say that is because the more that you increase your taxes on income, the less the incentive is to work, save, and invest. And so change the tax system accordingly to promote growth. Yes, cut spending, but don't be too draconian about it. Be draconian in terms of consumption spending, but lift your capex spending. And then, the Treasury has taken the very important steps of starting to address state-owned companies. I'm just concerned that Eskom is not the end of the line in terms of the problems that we get from state-owned companies. But you have to fix the financial position of the broader state-owned companies, because that's the broader balance, because these contingent liabilities keep coming home to roost. So that's what I would do as Treasury. As far as the SARB is, I would continue doing what I'm doing at the moment. The SARB is one part of a cog. It's one cog in a wheel, and it's done. It's a very good central bank. It's got a very clear mandate. It sticks to that mandate, and it's got high credibility. And that's all that we need and ask for from the Reserve Bank.
So you'll use your magic wand to say independence must stay there forever.
Independence. Independence in terms. I think the important thing is the mandate. The mandate is enshrined in the Constitution, so don't change the mandate. Sure. When I say that's all we need from the SARB, that's all we need on macro front. We need a lot of other things in other areas from them, and that's so for macro policy that's what I would do, but with a very keen focus on what I said on fiscal policy. I think that's critical, and we're not really doing that.
That's great. I'm gonna pass the magic wand to you, Laura. I'm gonna put you in an equally impossible situation where I give you the reins of the Federal Reserve Bank. And you have direct sway over the central banks in developed market regions as well, in that order. What would you do differently?
Ooh, that's
a
great question. I think what they're doing, I think they're being quite prudent in their approach because they are being dictated by the data. I think perhaps the forward guidance that we've seen previously has been a little bit confusing in terms of market watchers and how to absorb that. What would I do? I think ultimately it's about looking at the underpinnings of inflation now. So yes, rate hikes to a certain extent can curtail demand, and that can kind of weigh on the price pressures. But ultimately, we think that there's structural changes that are emerging in a lot of developed market economies, which do suggest that inflation will be higher despite what policymakers can do. So if we think about the workforce dynamics in the US, a key trend that's emerged from the pandemic is the fact that labor force participation rates remain well below what they were pre-pandemic. And we think a lot of those workers have exited the labor force and they're not going to come back. So that is really the supply-demand dynamics that could drive wage pressures higher, that could drive inflation even higher. As well, other factors of inflation, if we think about geopolitical fragmentation, we discussed how it's quite elevated in this current environment, and it's likely going to prompt this reorientation, this rewiring of supply chains, which we think will be a series of supply-side shocks over time as well. That's going to be inflationary. And then this kind of big picture trend that's emerging on the back of the focus on energy, the need for energy security last year is around this transition to net zero and the investment that's going to be required there. against this backdrop again, where we're seeing the supply-demand imbalances in a lot of key commodities that will be crucial to that transition. So that as well is inflationary. So yes, central banks are tightening policy. That's really their blunt policy tool that they can pull the lever on to try to curb demand. But I think there's a supply side story that they're not able to necessarily weigh on, and I think that's probably the key thing that's probably being missed. But again, their mandate is to keep inflation expectations anchored. So they're really kind of, their hands are tied in what they can do.
So both of you suggesting the central banks should just keep doing what they're doing, and I think that's also a good message. Is that those that are pulling the strings at our central banks are doing the right thing, and I think getting inflation in line long term matters tremendously. So that's all we have time for today. I thank you both for your amazing insights, and I'm sure everyone listening learned a lot, and might need to rewatch this and gather all the knowledge that you've shared. I thank you, and I'm going to try my best to get them back on this stage again in future. Next quarter, hopefully things improve. Hopefully there's less uncertainty, more certainty. You mentioned that. I think one thing you mentioned that the Fed can do a bit better is give better forward guidance, and I would agree. It does feel like a bit of flip-flopping at the moment that we're seeing from the Fed, and not having that exact path paved out, although that's easier said than done, right? So I thank you both for your time, for you for dialing in, and see you next time again. From all of us at Satrix, goodbye.